How to Invest for Beginners Part 2, What to Invest in. If you like the idea of being a multimillionaire, you're probably thinking about investing. But how do you know what to choose? There are stocks, bonds, mutual funds, Bitcoin and other crypto, collectibles such as watches, jewels, or rare automobiles, precious metals such as gold or silver, real estate. You could even get crazy and buy art. And besides that, you may have seen ads from others who are discussing things like day trading, forex trading, house flipping, buying land to start an Airbnb glamping location on. And alongside all those choices, there's the very real possibility that you could lose all the money you've worked so hard for. So in light of all this video is the ultimate guide to investment selection. We're going to break this lesson down into 3 parts. Part 1, the philosophy of why you would want to be in the investor class in the first place. Part 2, how to go about the business of identifying and selecting a great investment. And Part 3, do's and don'ts of investing based on what historically works and what historically doesn't. Now I have to warn you right up front that I'm not a financial advisor, and this is not financial advice, but I am a self-made millionaire. And no, I wasn't born with a knack for investing either. This is my first investment account ever, just a couple years after I started. Investing did not start great for me. I will also show you how I applied what you're about to learn and how this investment turned out later as a result. Part 1, the philosophy behind why you want to be in the investor class. You're 74 years old, and your bank account has $1,313 in it. You're holding a $12,000 hospital bill from an emergency surgery that just saved your life. It's 29 days until your next government check, but you still need to buy food. As far as the world is concerned, you're already dead. In 2021, 5,800,000 people in the United States over the age of 65 were living in poverty. That may seem like a long way off, but assuming we're blessed with a full life, that day will come. But if you haven't been massively dedicated to investing, it will be too late. The first reason to invest is because we want to make money without having to work. And fortunately, that's exactly what investing is. Instead of using labor to make money, we use money to make money. But there's a second, more urgent reason why you need to be in the investor class more than ever before, and that's because of inflation. Ever since the United States took its currency off the gold standard in 1971, the dollar has plummeted in value. This means we can't just leave our money in a savings account because it buys less every year. Housing, food, gasoline, nothing escapes dollar devaluation, aka inflation. And no matter what any feel-good politician tells you while they're campaigning, the United States is not on a track to repair this problem. In fact, they keep making it worse. At the end of 2021, 80% of all dollars in existence had been printed out of thin air over the previous 2 years alone. Simple supply and demand means with massive increases of dollars that didn't exist a moment prior, but the same supply of goods, more dollars are needed. And that equals rampant inflation that is still continuing years later. Part 2, how to select a great investment. What do Dave Ramsey, 50 Cent, and Abraham Lincoln all have in common? Dave Ramsey had creditors start calling for immediate payoff of his real estate loans at age 26. 50 Cent lost $470 million and ended up in front of a judge over it. And Abraham Lincoln was in his early 20s when he was ordered by a court to repay debt from a failed business over the next 17 years of his life. What these 3 men have in common is bankruptcy. So selecting the right investment matters. And here are 3 questions to ask when it comes to investment selection. How many ways can an investment make me money? How safe is it? And how much of my time does the investment require on an ongoing basis? As they say, there are many paths to the summit, but here we want to focus on paths that regular people like you and I can put in place quickly, easily, and safely. So we can then get back to living our lives, but knowing we've put the right financial foundations in place. That means nothing that requires being an accredited investor, nothing that is technically complex like crypto, which may get very easy to buy in the near future, but we'll cover that if it does. And we also want something that doesn't take a lot of money to get started in, like buying real estate or starting a franchise. And so we're going to focus here on choices within the realm of stocks, bonds, and mutual funds. Buying stock in a company means you're becoming part owner of that company. Buying a bond means you're essentially giving an institution a loan. And a mutual fund is a group of investments bought mutually by a group of people. So let's break them down individually. Now, stocks are good in that you can make money off them in multiple ways. First is the most understood way, and that is the value per share increases after you buy it. But there's a second way that stocks can make you money, and that's via dividends. Dividends are profit sharing on behalf of the company, paid to anyone who owns the company stock. It's money that gets deposited into your investment account that was never there before. Not all companies pay dividends, but they're truly passive income, and thus they're highly desirable. Now, many newer investors with good intentions get get on their brokerage app of choice and buy shares of companies that have high levels of public awareness, like Apple or Amazon or Google. Or they may buy shares of companies who align with their values, such as environmental awareness. The problem with this strategy is the buying of individual stocks part. You see, depending on the study, between 92 and 96% of professional money managers cannot pick stocks which make you more money than the average of the stock market overall. And these are people with financial degrees or who've trained and obtained licenses and who focus on it all day, every day. Therefore, most non-professional investors like you and I don't make money buying individual stocks either. Bonds are another traditional investment, and if you select highly rated bonds, they're generally viewed as being low risk. But while there are periods in history where bonds are a good idea to own, they tend to lose you money during periods of high inflation. This is because to make you money, they have to increase in value faster than inflation. If inflation is 6% and a bond pays 3%, you lose 3% of buying power every year you keep that bond. And if, after you buy it, you realize this problem and want to sell it, you'll probably have a penalty of some kind to do so. Since real inflation of assets has been at 7 to 9% or more for years on end now, and because bonds pay less than that, the investment has been a net loss for quite a while. Therefore, bonds are not on my investment list for the foreseeable future. Mutual funds. Mutual funds are groups of investments, such as groups of stocks, groups of bonds, real estate, and so on, bought by a group of people and managed by professional money managers. Depending on the content of the fund, they could meet all of our goals. If they comprise of real estate or dividend-paying stocks, they could make us money by both simple appreciation and by cash payouts. And if they're well diversified, they could be safe. So taking all that into consideration, what do we as everyday people actually choose? I'm going to cite Warren Buffett here, who's built a net worth of over $100 billion from nothing.
So this time I went back to when I bought my first stock. We've had 14 presidents, 7 Republicans, 7 Democrats. We've had world wars, we had 9/11, all kinds of things. The best single thing you could have done was just buy an index fund. Never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. I pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and it would come to $51 million now.
So what exactly is an index fund, and more specifically the S&P 500 index fund that Warren talks about? An index fund is a special type of mutual fund or exchange-traded fund that represents an entire market. The most common example is an S&P 500 index fund, which means the fund contains the stocks of all the companies in the S&P 500 index. Now, index funds were first made widely available by John Bogle, the founder of Vanguard. This was in the 1970s, and they removed the exorbitant fees being charged by the rest of the industry. Warren therefore refers to John Bogle as a personal hero, as index funds provided a path for everyday people to safely enter the investor class. Here's how an S&P 500 index fund actually works. Each of the 500 companies does not represent an even share of the index. Here you can see that at the time of this video's recording, Apple made up about 7.4%, and next down the list was Microsoft at 7.1%, followed later by JP Morgan Chase, which has 1.2% of the index, and so on. Then down toward the bottom, you'll see some additional names you may recognize like Bath & Body Works, Paramount, and Whirlpool, each with less than 1% of the index. So the way this works then is for every $100 of an S&P 500 index fund you buy, you would have exactly this percentage of your $100 go into companies in the index. Apple's 7.4% would be $7.40 out of your 100, and so on. So let's review this investment option against our selection criteria. How many ways can this investment make me money? You can of course make money off the appreciation of the stocks themselves, but many of these stocks also pay dividends. How safe is it? First, this approach spreads your investment money out across 500 different companies, preventing one of those companies going bankrupt and becoming worthless from setting you backwards very much. Second, these are 500 of the strongest companies in the United States, meaning you're essentially betting on the strength of America as an economic powerhouse. How much time does the investment require on an ongoing basis? Once you make the initial investment, which could take a few days to get set up with a brokerage account if you haven't one already, and 10 minutes or less if you already do have one, there's no ongoing time needed at all. Compare that to the investment lifestyle of trying to manage an Airbnb or 5. And finally, compared to flipping houses, managing rental properties, options trading, or running a company with employees, index fund investing is easy. So with an index fund, anyone can get started wealth building almost immediately, which is one more reason they rock. Part 3. Investing do's and don'ts based on historical data. To close the loop on my catastrophic entry into investing, I was about 2 years into my wealth building journey and staring at a sea of red. This was not technically an index fund, but it was a diversified mutual fund. So what did I do? What didn't I do? How did it turn out? And how can we learn from it? The first do is visible on this graph. The black line on the bottom is the money I'd put in, and the jagged line on the top is the value of the investment overall. Here you can see those little stair steps on the left, which is the automation of my investments. The reason to do this is because there's no more certain way for money to pile up than configuring the investment to happen automatically. Then you can see on the right, when I went to a different company, the automated deposits stopped because I no longer had income from that company going into the investment every 2 weeks. But this example doesn't just apply to me. In this Warren Buffett guide to investing from CNBC, you can see he calls out here to make sure you're making regular contributions. Don't. Our first don't is don't buy and sell the index fund trying to time the market. As itchy as my trigger finger was to sell, I'm glad I didn't. This mutual fund investment not only recovered from its short period of loss, but absolutely exploded in value. Do. Our next do is to continue learning about more ways to keep and grow your money. Index fund investing is a solid wealth building tool, and like Warren, I absolutely believe it to be the foundation for building a financial fortress upon. But there are additional paths to the top and nothing preventing us from using them as well. If you're interested in more ways to wealth build, you may want to subscribe. Don't. Our next don't is not to be swayed by your friends and family to quote-unquote pause your index fund investing in order to buy their stock of the moment, or even worse, to take money out of your index fund to buy into some quote-unquote special opportunity, or to save someone's family business. I've personally made that mistake twice. In doing so, I was putting myself back into the 92 to 96% of people who can't beat the investment that I was already in. And because I let myself get talked into something, I lost all of that money both times. Part 4, what to do about the slow time to wealth. But there's one little thing we haven't talked about yet, and that is that as solid as index fund investing is, it takes time, typically decades. So what if we want to speed things up while still maintaining all the security that we just learned about? We'll cover that in this next video in the series right here.